Welcome back to another episode of Market Brief After Hours. We're wrapping up a very busy Friday, and there is a lot to unpack from today's trading session. From geopolitical drama in the Middle East to massive swings in chip stocks and some unexpected tariff announcements, global markets have been anything but quiet.
That's absolutely right. It's been a classic tug-of-war between geopolitical risk and macroeconomic data. We saw some wild swings, especially in oil and technology, before things settled down a bit by the closing bell.
Let's start with the major U.S. averages. How did they wrap up the day?
Well, it was a mixed bag. The S&P 500 ended the day practically flat, squeaking out a tiny gain of 0.05%. The tech-heavy Nasdaq composite felt the brunt of a semiconductor sell-off, dropping 0.6%. Meanwhile, the Dow Jones Industrial Average was the day's winner, gaining 235 points, which is a solid 0.5% bump, largely thanks to a 3% jump in Apple.
That's a decent bounce for the Dow, but what does the weekly picture look like?
The weekly picture is a bit more sobering. Despite Friday's mixed action, all three major indexes finished the week in the red. The Dow fell 0.5% for the week, the S&P 500 lost 0.7%, and the Nasdaq took a heavier hit, losing more than 2% over the last 5 days.
It sounds like the weekly trend was definitely weighed down. What was driving that anxiety, particularly on Friday?
Geopolitics was front and center. Earlier in the week, President Donald Trump mentioned he was considering a massive attack on Iran, bigger than anything seen in the conflict so far, saying Iran hadn't received enough pain yet. The New York Times even reported Friday that he was meeting with senior advisors to make a final decision. That had traders incredibly nervous about staying long over the weekend, especially with U.S. forces completing their 13th consecutive night of strikes on Iranian targets.
But we also saw oil prices drop significantly on Friday. How did that happen with all this tension?
It was a classic headline reversal. Reuters reported that Pakistan is exploring a path to establish new peace negotiations between the U.S. and Iran, a push apparently initiated and backed by China. Even though the sources noted the obstacles to these talks remain very high, the mere mention of a diplomatic path caused oil to pull back sharply. Brent crude futures, which had topped $100 a barrel earlier in the week, fell nearly 4% to settle at $96.78. U.S. West Texas Intermediate, or WTI, dropped 3% to close at $89.31 a barrel. In fact, UBS is now forecasting Brent to fall to $85 a barrel by the end of the year.
Wow, a significant drop. And I imagine that relief in oil prices flowed into the bond market too.
Exactly. Treasury yield slid alongside oil. The yield on the 10-year U.S. Treasury note, which is the big benchmark for consumer debt like mortgages, dropped more than 2 basis points to end at 4.681%. That's down from Thursday when it spiked above 4.7%, its highest level since January 2025. The 2-year yield, which tracks the Fed's near-term policy closely, also pulled back over 2 basis points to 4.333%, while the 30-year yield sat relatively flat at 5.164%.
Let's look at domestic economic data. We had some fresh PMI and housing numbers today.
Yes, the economic data was quite interesting. The S&P Global U.S. Manufacturing PMI edged down slightly to 53.8 in July from 53.9 in June, missing the market expectations of 54.3. However, the S&P Global U.S. Composite PMI, which combines manufacturing and services, rose to 53.6, its highest level since November. That was driven by a really strong acceleration in the services sector. On the housing front, new single-family home sales in the U.S. rebounded in June, rising 1.6% to a seasonally adjusted annualized rate of 628,000, beating forecasts of 610,000. Interestingly, the median sales price fell to $398,300, down from $412,000 in May, which probably helped spur some of that buying activity.
Fascinating dynamics. Let's take a very quick break, and when we get back, we'll dive into how international markets fared, look at some major currency movements, and cover the big individual stock movers of the day. Stay with us. Welcome back to Market Brief After Hours. Let's shift our focus across the oceans. Europe and Asia had very different stories to tell on Friday. Let's start with Europe.
Europe actually had a pretty strong day, closing on a firm note despite the Middle East tensions. The Pan-European Stocks 600 climbed 0.82%. Looking at individual countries, the UK's FTSE 100 ended 0.91% up,
Germany's DAX gained 1.36%, France's CAC 40 rose 0.88%, and Switzerland's SMI settled up 0.79%.
What was driving that European optimism?
It was a mix of upbeat earnings, falling oil prices, and decent economic data. For instance, in the UK, consumer confidence jumped 6 points to -17 in July, the biggest increase since November 2023, with optimism rising as Andy Burnham prepares to take the helm as Prime Minister. UK retail sales were also up 1% on the month, and the manufacturing PMI beat forecasts, coming in at 52.8. Germany had a bit of a mixed bag. Their Consumer Climate Index fell slightly to -29.6 for August, but their Flash Services PMI rose to a 4-month high of 49.6, showing business activity is near stabilization. France also saw its composite PMI rise to 49.6, driven by a 7-month high in services.
So Europe was showing signs of resilience. Asia, on the other hand, didn't seem to have the same look.
No, Asian markets had a rough Friday. A big part of that was surging oil prices earlier in the session, fueling inflation fears. But there was also a major policy shock. The Trump administration announced it would impose higher tariffs of 10 to 12.5% on 60 trading partners, replacing a temporary 10% global tariff. This hits major economies like China, Japan, India, the EU, the UK, and Canada.
That is a massive headwind. How did the specific country indexes react?
China's Shanghai Composite slumped 1.61% to close at 3,814.20, also weighed down by worries that the upcoming listing of memory chip maker CXMT could drain liquidity from the market. Hong Kong's Hang Seng fell 0.98% to 24,963.23. In Japan, the Nikkei average plummeted 2.73%, and the Topix fell 1.05%. Driven by rising domestic inflation, which hit 1.6% in June, and a major tech sell-off over whether massive spending on AI infrastructure is sustainable. South Korea's KOSPI was hit even harder, plunging 5.72%, with giants like Samsung and SK Hynix dropping 7%. Down under, Australia's S&P ASX 200 dropped 0.75%, and New Zealand's S&P NCX 50 slipped 0.17%.
Let's talk currencies and metals. We have some detailed technical data here. What's happening with the euro and the pound?
The Euro-USD pair is facing significant downward pressure. It closed on Friday at 1.1370, down 0.06%. Technically, it's trading well below its key moving averages, with the 50-day simple moving average at 1.1498, the 100-day at 1.1573, and the 200-day at 1.1634. This downward slope confirms a dominant bearish trend. If it breaks below its immediate support at 1.1350, we could see a deeper slide. On the other hand, the GBP-USD pair managed a tiny bounce, closing up 0.06% at 1.3322. However, it also remains below its moving averages. The 50-day is at 1.3369, and the 200-day is at 1.3398. It's a tentative pause after a sharp decline from above 1.3500, but the overall bias remains heavily tilted to the downside.
What about the Australian dollar and the Swiss franc? Those charts look a bit different.
They do. The AUD-USD pair edged up 0.19% to close at 0.6980. It's currently consolidating in a sideways range, sitting right between its 200-day SMA below at 0.6895, which is acting as a solid floor, and its 50-day SMA above at 0.7023, which is serving as a key technical ceiling. Now, if you want to see a powerful uptrend, look at USD CHF. It extended its advance, closing up 0.20% at 0.8183. It is trading substantially above its moving averages, with the 50-day way down at 0.8002 and the 200-day at 0.7919. This chart shows a beautiful series of higher highs and higher lows, and there is very little sign of bearish intervention right now, as it eyes the psychological 0.8200 level.
And how are the safe haven metals, gold and silver, holding up amidst all this geopolitical tension?
Gold is currently in a consolidation phase near its recent base, closing up 0.10% at $4,052. It's still in a dominant medium-term bearish trend, trading far below its 50-day SMA of $4,250 and its 200-day SMA of $4,482. The critical $4,000 level is acting as a major psychological floor. Silver had a stronger recovery on Friday, jumping 1.02% to close at $58.19. But like gold, it's still deeply embedded in a bearish structure, trading well below its 50-day SMA of $66.25 and its 200-day of $69.94. This looks like a corrective bounce from recent lows near $56, but the overall momentum remains negative.
Let's wrap up with the single stocks that made waves today. We saw some massive individual moves, both positive and negative.
We did. On the positive side, Booz Allen Hamilton popped 10% after beating fiscal first quarter earnings estimates, posting $1.81 per share versus the $1.48 expected. German software giant SAP rose 9% because its cloud backlog grew 27% year over year to 22.9 billion euros.
But the chip sector and some of the AI names took a real beating, didn't they?
Absolutely. Intel fell 8%, reversing its earlier gains despite posting Q2 results that actually beat expectations. That dragged down other chip makers. Broadcom and AMD fell 3% each, Micron declined 7%, and the VanEck Semiconductor ETF pulled back 3%. In the AI cloud space, Nebius Group dropped 15% to close at $188, and CoreWeave shares fell 11% to $72, despite having a massive $99.4 billion revenue backlog. Finally, Astera Labs closed down more than 10% at $292, continuing a tough month for the tech sector. Even Oracle fell over 4%, which is surprising because they just announced a massive 10-year contract with the U.S. Department of Defense, valued up to $7 billion.
A lot of moving parts to keep track of as we head into the weekend. Thank you for tuning in. If you find this useful, please follow Market Brief after hours. Have a great weekend, and we'll see you next time.